All right, welcome. Today's video is on building narrative. All right, hopefully you guys will enjoy this one. All right, so building narrative. Google definition of narrative is a spoken or written account of connected events, a story. So narrative is your reason why. It is a story that is leading towards a destination in which we can speculate on with a fairly high degree of certainty, right? So you're looking at past events, current events, right, to give us clues as to what price may do in the future, right? So consider a long-term stock picker. What do they consider when buying shares for their retirement portfolio? They consider companies that have a good story, maybe a growth story, right? Innovation, upcoming catalysts, right? Maybe it's a consistent dividend or moat, right? Something about the story of this company. What do they do? What is the need they're trying to meet, right? And they build a thesis or argument to justify why they believe this is a good company to buy and hold for the long term, right? In essence, they believe in its story. As day traders, we're looking to get in and out of the market quickly, right? So we don't look for fundamentals necessarily to tell us a story, right? That's mainly for longer term outlook. We look at what price is doing right now. Where did price come from? What is it reaching for? Now, there are many tools and pieces of information that traders can use to obtain their short term bias. Some traders may use indicators such as moving averages or RSI, VWAP. Some may use opening bar range. There's literally hundreds of different tools and ways that traders have come up with to give them an indication of where price is going. Right. In this video, I will attempt to provide a few different ways that I look at the market in order to come up with my narrative. Right. You guys might have different ways that you come up with narrative, but this is just some of the ways that I do it. Right, and this is just going to be a brief overview, a beginner series. Later on, we will go into some more nuances and some exceptions to the following. Right, but the first thing I look at, of course, is market structure. Right, gave a whole video on this before this one. Right, and in that video, I mentioned market structure alone is a powerful tool in giving us a short-term bias. If price is trending up, we should primarily look to buy long on pullbacks. If price is trending down, we should primarily look to sell short. Right? This is because the likelihood that price continues in the direction of the trend is higher than not. Right? So I know a lot of you use market structure, and I think that is how price moves is based on structure. It's based on the order found amidst the chaos and randomness. And if you follow structure alone, it can give you a profitable edge, a lot of the times, right? But you may not market structure may not be enough, right? There could be a lot of movements in between before it makes its move, and there's market structure in different time frames, and so there is more to know than just market structure, right? So what else you can look for is a sign of strength, right? So you're looking for bullish or bearish responses to price movements, right? So within market structure, you can refine further, narrow down, and combine market structure with a sign of strength. For example, value low, right? Value low is when the lowest bearish candle closes met with the bullish candle close above it. This is one sign of strength that bulls are starting to show a stronger response, right? A value low can also be considered what we call a candlestick flip, right? So it's the beginning. It's the potential that now bulls are stepping in, and we see that by overtaking the previous bearish momentum, right? Now a stronger sign of strength from bulls would be an actual structure flip, right? A higher time frame flip, for example. A structure flip is where on the long side is where bulls overtake a bear swing, right? So the entire move down, right? Bulls are able to overcome the entire movement, right? Overcome all the selling pressure, and basically flip structure, right? So as structure flips, right, the expectation now is that we can start trending higher, right? So on pullbacks, you're looking for an entry to go higher, and your short-term buys should actually be higher, right? Especially if we have met the short objective, right? So which we will look into next or soon. Right. So the next thing is looking for a sign of strength. We're looking for failures, right? So failure to close or to make a new extreme can give us clues about the strength of bulls or bears, right? So in this picture we have um, bullish momentum, bullish structure, but the bulls here have started to show some weakness, right? And we see that because they failed to make a new high, right? Not only that, though, we do see a valid high being put in, showing strength in bears, right? We see a strength in bears here with the first valid high, right? Price came up, failed to make a new high, and we got another valid high here, showing bears are showing signs of strength, right? So this sign of strength, right? Weakness in bulls, strength in bears, resulted in the low being taken, right? Which would be the objective of the bears at this moment, right? Now, once we reached here, we did see some bears come in with the valid low being put in, right? Sellers are still here though, have not given up fully yet. Some selling here, but the selling is not enough to make a new low, right? So we see some response from the bears to continue lower, but we see an even stronger response from the bulls, right? Failure to close below and a valid low being put on indicates signs that we are heading higher and we're ready to resume the primary trend. Right? Repeated failures, right? If you see repeated failures as well, sometimes looking for two extremes, right? Two extremes often results in a reversal, right? So you can wait to see price action, you can wait to see bullish and bearish response, right? And once it gives you a clear indication of which one is stronger, that can assist you in coming up with your short-term buys. All right, so the next way that I look at narrative building is what I like to call thinking like smart money, right? So smart money is either seeking liquidity in the form of old highs and lows, or seeking inefficiencies or unfilled orders found in imbalances or S&D zones, right? So think of it this way, right? Where do most traders place their stop losses? Right? And this concept you'll hear a lot from ICT, who's a lot of his concepts are derived off of liquidity. But think about it, right? Where do traders place their stop losses? Generally above old highs or old lows, right? Especially relatively equal highs or lows, right? Now, if you knew that and you had enough money to move the market, right? How would you take advantage of that? Right? So if you knew that there were buyers above old highs, what you would do is you would buy low and then bring price up to those old highs, right? To run those buy stops. So for example, here, this picture here, you see some selling pressure here. So buyers are smart money would buy low here, right? Taking those sell stops, then they would bring price up to run the buy stops, therefore buying low and selling high, right? So smart money is always buying low and selling high, where far majority of retail traders and investors are doing the opposite, right? Retail traders are buying high and selling low. Okay, so smart money will often engineer liquidity below an old low, sweep those lows to buy from those sellers into an S&D zone that they want to step in and defend price. Then they want to take price higher where they can sell their newly bought inventory, right? So if looking at this picture, right, we know that there are buy stop orders up above, right? But before they run those buy stop orders, they need to fill their inventory. They need to fill their bags lower before they bring up to those buy stop orders, right? So they first they bring price down and it actually engineers buy stop orders to be created. Then they bring price down and they start engineering sell stop orders, right? So they create these inducement runs up, right? And this move up engineers or creates buyers who will enter the market once they see this bullish momentum, right? Once they see sell stops below, they'll then come down and run those sell stops. And particularly important is this S&D zone. The S&D zone is where there was previous buying from the smart money, right? And presumably there are unfilled orders left there that they want to fill their bags from. So by creating this inducement, right, they're engineering liquidity to be taken so that they can buy at their original price point, right? So they want to buy more, they want to fill their bags more in order to bring price up so that they can sell here, um, where their buy stops reside, right? So therefore, they are buying low. They're engineering liquidity so they can buy low and to sell high. Most retail traders, they're doing the exact opposite, right? They're looking at these down move and they're getting scared and they're selling here to the market makers or to the smart money. They're selling here and they're buying on the move up when they shouldn't be, right? And so they're buying high and they're selling low. Right, so consider news days, right? Why are news days so hard? On some days where there is heavy buying activity, perhaps from a news catalyst, price may initially pop on news, creating a frenzy and FOMO for retail players who are now buying at elevated prices. Often, what will happen next is that smart money will cause a large drop in price, so that these buyers become scared out of their position and sell their shares back to the market at lower prices. Therefore, again, far majority of people are buying high and selling low. Okay, consider the game of chess, right? So the Queen's Gambit. If you guys haven't watched that series, it's an excellent series. I highly recommend it, right? But in the game of chess, right, especially chess master, right, one of the moves he might do is he might sacrifice one of his pieces, right, such as the queen, which would be called the Queen's Gambit, right. In doing so, the master knows that if he does it and the opposing player takes the bait, right, the opposing player will play precisely into the master trap and lose the game, right? Thus sacrificing in the short term for the long term game, right? So the market is always performing gambits, right? It's always manipulating, or other people call it a Judas swing, a manipulation, right? Price, smart money is always taking price to where smart money can fill their orders in order to take from the retail traders before bringing price to where they can unload their price once again. Understanding this narrative, one can attempt to think like smart money and anticipate some of these movements. Another way to think about this is thinking about market maker inventory, right? So one of my first trading mentors was a former Wall Street market maker, and he shared with me that market makers are regulated and required to hold a specific amount of inventory at all times, and they do that because they provide liquidity to the markets, right? Well, in days where there's heavy buying from many market participants, right, their inventory is depleting, right? So they either need to find sellers, right, that are often below old lows, right? Or they need to, they need to bring, as price is going up, they need to bring price back down. That's why price doesn't just go up in a straight line, right? It's because market makers need to bring price down in the form of manipulation to do the swing to take out some of those buyers to find their stop losses, right? To engineer selling so that their inventory can become balanced, right? So they're either gonna bring price lower so that they can fill their inventory, or they also need to do buying, right? Sometimes, in heavy buying scenarios, where they can't find sellers, right? They need to do the buying themselves, right? So they'll buy, and what they'll do is they'll continue to find new buyers that are FOMOing in high prices, and not only that, they're taking out short sellers, right? So oftentimes during parabolic moves, you'll see a lot of people try to short every new high, right? Short, 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 and what happens is that their buy stops keep getting taken out, right? The more shorting there is at elevated prices, you'll see that price can just go on a short squeeze and go higher than most people expect, just because you have these shorts that keep trying to short the market, right? So knowing that the market can do this, and knowing some of the narrative, you can avoid shorting when price is going on a parabolic move up, right? You can avoid shorting, right? And finally, location is important, right? Market makers know that there are leftover orders that lie in imbalances or fair value gaps, right? And oftentimes, they look at S&D zones where they did not get filled on their order, right? Sometimes they are switching from longs to shorts, vice versa, so they need to mitigate certain areas multiple times before they're ready to move in their intended direction, right? So S&D zones, right? Traders buy stop, sell stop orders residing near previous highs and lows, right? They are often going back and forth between various areas, engineering liquidity, sweeping areas multiple times until their orders are filled, right? Until they have balanced their inventory enough and gotten enough shares at the price point that they want before they're ready to finally move the price in their direction. Right? So in summary, right, short-term bias is asking the question, where did price come from? What is it reaching for? Has smart money obtained enough liquidity to one side and is ready to take it to the other? Has price taken liquidity residing below engineered lows into an S&D zone or fair value gap where smart money seeks to fulfill all of their orders? And is price showing a sign of strength that is ready to reach for opposing liquidity? Right. So this is the story that that the market is telling you. Should you watch and read it? You can actually look and see what is price, where did price come from, and where the expectation is that it's going. Right now, narrative building is piecing together a series of events or key pieces of information in order to determine the highest probability destination. Right, narrative building is not enough. Okay, now this is important, right? In a market, there are many market participants, so even the best storytellers get their narrative wrong, right? So even knowing everything that I've told you, right, we can get our narrative wrong, right? While it is important to understand components of narrative building, we may sometimes not know the true intention of market makers, nor know whether they have had enough of their fill on the upside or downside. We might not know, right? So that's why, in addition to narrative building, right, you also need to combine it with current price action, right? So is price showing a sign of strength, a sign of weakness, right? What is price currently doing it? Did it just flip, right? If our narrative is bearish, is price going against our narrative, or is it going with our narrative, right? And alongside that, you need to get a very specific entry model of when to get exactly involved, right? Just because you see you have your narrative and you see price going along with your narrative, that's not a reason to enter, because you may be getting in late, you may not be getting in at the best entry, price may still come up and manipulate again. So you also need an entry model as well, right? So be very careful with narrative. Narrative is absolutely important. And if you get narrative right, and if price action shows that it is aligned with your narrative, and you get your specific entry model aligned. So again, the narrative is correct, the price action is aligned with your narrative, and you get your entry model in the direction of your narrative, and you have your target, right? Those are very strong. It's going to provide you with the highest possible probability for your trade, right? All right. Well, hopefully you guys enjoyed this session. I mean, this is just there's still so much more that can be discussed. But this is just some ways that I view price and try to think about what price is doing. Hope you guys enjoyed this one, and I'll see you guys in the next one.